Analysis of LVMH financial statements by Group 10, Tina Davis, Lucia Deloa, Zhu Chen, and Malia Buck.
We choose the company LVMH to analyze their financial statements because we thought it would be interesting to compare financial statements of a company who produces brands and products that we are all familiar with. The LVMH headquarters are located in Paris, France. However, they operate and conduct business in many countries, including the United States, employing around 125,000 people globally. Some of their brands include the prestigious Moet et Jean, Louis Vuitton, Givenchy, Makeup Forever, Benefit Cosmetics, and Sephora are some of their other high-quality brands that we are familiar with.
For this project, we used the most current financial statements of LVMH, which were the years 2015 and 2014. However, comparative data in the financial statements includes 2013 as well. LVMH labeled these their consolidated financial statements. LVMH's fiscal year end is December 31st, and their document of reference includes information about the company, the consolidated financial statements, as well as the required disclosure notes.
One interesting difference that we found in LVMH's financial documents was their classification of transactions in their statement of cash flows. IFRS allows entries to classify dividends received as either operating or investing activities. LVMH has decided to classify their dividends as interest activity. LVMH also double classifies their income tax paid. A portion of income taxes paid is classified as an operating activity, and the other portion as an investing activity, depending on the nature of the taxes.
Some other differences we found in the financial statements of LVMH were related to the presentation of the statement of cash flows. We were drawn to the statement of cash flows because IFRS offers a lot more flexibility, not only with the classification of accounts, but also in terms of presentation. Under GAAP, entities use the single-step format and expenses are presented by function only. However, IFRS allows expenses to be presented by nature or function, and LVMH reports their expenses using nature. Also, the presentation of the balance sheet under IFRS allows more flexibility than US GAAP. Under GAAP, items must be presented in order of liquidity, whereas under IFRS they do not. LVMH does not present its balance sheet in order of liquidity, and they list non-current assets first.
Convergence of standards has had an effect on LVMH since they are a foreign company that operates in the US. As a result of the Norwalk Agreement, LVMH no longer has to reconcile their financial statements to US GAAP. Another benefit of convergence is related to borrowing costs. Before, LVMH would be required to expense all borrowing costs that were incurred. Now they can capitalize these expenses over the asset's life. This is a benefit, especially since they have assets that take a long time to get ready for their intended use or sale. This is important since LVMH owns a lot of vineyards and produce wines and spirits that generally takes years to get ready for their intended use.
Some of the topics that we found interesting when analyzing LVMH's 2014 and 2015 financial statements were the valuation of inventory and impairment loss. Due to the nature of certain products that are produced, LVMH uses a combination of LIFO and weighted average to value its inventory. For example, due to the aging process of wine and champagne, these items are recorded using the lower of cost or net realizable value, using the current rate that they would receive depending on the market. LVMH also records impairment loss in the equity section, and reversal of impairment is recognized in the income statement at the point of sale.
After analyzing LVMH's financial statements, we have come to the conclusion that this is a stable company with increasing revenues over the years. The information in the financial statements was complete, relevant, and reliable for general purpose users. Overall, our group worked well together over the semester. Everyone displayed personal accountability when it came to their contributions to the group. Technologies such as Blackboard and Google Drive were an asset to the group, and we use these mediums of communication frequently.
Thank you for viewing our presentation. Please refer to our appendix for the consolidated financial statements we used.